Today's topic, and thank you all for joining, is business lending deep dive. We've hosted a multitude of webinars over the past year or so, but wanted to move into this first quarterly product webinar with a focus on our business lending programs. My name is Craig Blodgett. Most of you already know me. If you haven't met me before, it's a pleasure to meet you. I'm the Senior Manager of Partnerships here at Loanspark. Here's my contact information if you'd like to reach out to me for questions afterwards, or if you have an assigned account manager, reach out to them with any questions. Also on this call, I do have my Director of Marketplace Lending, Thomas Black, who will be supporting me, and he'll go into some of the deep dives on the products once we go into the presentation. So to kind of kick things off here, what is Loanspark? Because I know we have plenty of partners on this call who are already activated with us, and we have prospective partners as well. Loanspark is a business lending as a service platform. We actually just had business lending as a service trademark to us recently as well, so that's super exciting. We're essentially a bolt-on business lending service that allows you to offer to expand your suite of lending offerings, or to better service your current clients with your offerings through us very quickly. We have access to 300 plus lending programs. We act as both a direct lender, correspondent lender, and syndicate within our marketplace to provide the best solution to you and your clients. And we're licensed in 47 states. So anything out of North Dakota, South Dakota, or Vermont, we can service. And you don't need additional licensing as a broker or as a partner to work with us. You're able to tap into our licensing by partnering with Loanspark, allowing you to tap into these markets in all 47 states. Also, you have the flexibility with us to either refer files or broker files. At the end of the call, I'll go into a couple of differences between the two, but essentially, you're able to work with us, in a combination of different ways, which is highly advantageous to you as a partner or a broker. And we are SOC 2 Type 2 certified, meaning that we take your data and your customers' data security very seriously. Some of the business lending programs or products that we offer, and Thomas will provide more insight into each of these on a more granular level, are short-term business loans, lines of credit, bank term loans, equipment financing programs, rapid SBA loans, and SBA 7A loans. We do have other type of lending categories that are more niche, but by understanding these categories at a high level, you'll be very knowledgeable in the business lending space and be able to perform as an effective partner to service clients, generate revenue, attract new ones, etc. With that being said, I will turn it over to Thomas Black to give us some insights on these business lending products.
Awesome. Thanks, Craig. So like Craig said, my name is Thomas Black. I'm the Director of Marketplace Lending here at Loanspark. So one of my primary roles within the company is to assess your customers' needs when the deal comes through our doors and determine which of these loan programs is going to be the best fit for them. So kicking off the list today, the first product that we're going to discuss is the short-term business loan. So what is this? As the name suggests, it's a loan that's shorter term in nature. The term lengths are going to range from 3 up to at most 24 months. The customer will be responsible for making payments on a daily basis, a weekly basis, or in some cases a bi-weekly basis, but never a monthly basis. Finally, the cost of capital that your customer is going to be paying is going to be based on a factor rate. So when is this a good use case for your customer? Well, the most common use case that we see is working capital. So they just simply need capital to help run their business on a day-to-day basis. But it's also great for other use cases like buying inventory, making payroll, marketing expenses, hiring new employees, and many, many more. So some of the strategic goals or benefits of this product, first and foremost, is going to be convenience and speed. So here at Loanspark, this is one of our most popular products due to the fact that we can underwrite, approve, and fund these deals inside of 48 hours. It also has the highest approval probabilities of any of the products that we offer. And if your customer is looking to pay this facility off early, they may be able to do so with limited penalties or fees, and in some cases, 100% forgiveness. So the first thing to understand when trying to determine if your customer, whether you're referring or brokering a deal, the customer is a good fit for this product, is kind of their borrow criteria and whether or not it kind of fits within the box that we've put forth. So on the screen, you see two different categories, your required criteria and your preferred criteria. So if the customer meets the required criteria, meaning they've been in business for at least 6 months, the guarantor's FICO is 575 or higher, and their monthly revenues are in excess of $10,000, that means they would qualify for this program. Any of those numbers that fall below those thresholds, it's going to be tough to secure an approval, and we will likely not be able to fund a deal like that. Now, the preferred criteria bucket is more of, hey, if they meet these criteria, they will qualify for the highest degree of options that we have, and probably more competitive terms as well. So for customers in business at least 2 years, credit scores above 650, and monthly revenues over 25,000, you're going to see better offers, more offers, etc. So again, when you have a customer looking for working capital, these three categories, time and business, FICO, monthly revenues, are going to be kind of the first things you can assess to say, hey, is this product a good fit, or do we need to pick another route? So you're probably also wondering how we come up with terms and pricing for a product like this. And so I'll walk you through that now. So as the prior slide indicated, the three main drivers are going to be how long they've been in business, what kind of monthly revenue are they generating in this business, and the personal credit score. One other factor that's also going to come into play is industry. So there are some industries like construction and trucking that are going to be considered higher risk industries as opposed to some others. And so for customers in those lines of work, that may impact their approval in a positive or negative way. But those three key drivers are always going to kind of be what we're looking at first. There's also other factors like their funding position. So if this customer has taken a short-term business loan in the past and is still responsible for making payments on this facility, that may impact their approval, as well as any information coming from their bank statements, such as their average daily balance. Do they maintain a positive balance, or are their expenses outpacing their revenue? And then negative days, or NSF, which is non-sufficient funds. So are there days where that balance falls negative? And then the number of deposits that they make to the account on a monthly basis. So if you have a business where the bulk of their deposits are coming from 2 customers, that would be considered higher risk because there's a lot more potential volatility there. If that buyer has something go awry on their end and now they're not able to make payments, that's considered higher risk than someone who's collecting, say, 1,000 deposits a month from 1,000 different customers. So I'll quickly walk through kind of what an example approval of one of these deals would look like. It's going to have 3 key factors that are important to understand. So the first is, of course, the approval amount, how much money they've been approved for. The second is going to be the term length. And within the term length, there will be an indicator of their payment frequency. So if you see an approval for 40 weeks, this indicates that the customer is going to be making weekly payments. If you see an approval for 120 days, you know that they'll be responsible for daily payments. And again, sometimes there will be, hey, it's 40 weeks, but it's bi-weekly payments. So of course, 2 payments a month, that may be an option as well. And finally is going to be the factor rate. So for those of you who are not familiar with factor rates, this is essentially a multiple of the approval amount that indicates what the customer is responsible for repaying. So in this example, customer's been approved for $100,000 at a 1.20 factor rate. They're going to be responsible for repaying $120,000. So essentially the $20,000 is the cost of the capital. So to come up with what their payment is going to be, you're simply going to take that total repayment amount, which is derived from the loan amount and the factor rate, and divide it by the number of payments indicated in the term. So you've got a 40-week approval, $120,000 worth of repayment, and you arrive at a payment of $3,000 per week. So fairly straightforward when it comes to calculating payments. So typical terms for these borrowers, kind of like I mentioned before, they're going to range from 3 to 24 months. I would say borrowers that are considered top shelf A+, you may see approvals in the 12 to 24 month range. But because this short-term business loan is considered a higher risk product, you will see a wide variety of offers coming in under 12 months. So that may be 8 months, or it may show up as 40 weeks or 200 days, right? There's a pretty wide variety there, but I would say only highly qualified borrowers are going to see offers coming in over 12 months. The best case scenario on the factor rates is going to be somewhere around a 1.15. That may range as high as a 1.4, 1.45, just depending on the risk profile of the borrower. Again, this is a pretty wide, this product casts a pretty wide net, so it's available to It can be used for anything from a borrower who's highly qualified and could get approved at the bank, but they just need capital quicker. They need to fund inside of 2 days, or a borrower that's just started out, has trouble with their personal credit, and is considered higher risk and therefore going to qualify for higher risk terms. So again, 1.15 is going to be best case, but it ranges pretty high up from there. And finally, a best case scenario for A+ borrower is going to be weekly or biweekly payments. But again, for lower risk or for higher risk borrowers, you're going to see options of daily payments as well. So on the screen, we've got a couple examples of deals we've funded in the past year, kind of when this product was a good fit. So the first business was a company in the construction services industry. So the reason that they came to us is that they were in the process of securing a line of credit with a large national bank. Like, well, I don't think it was Wells Fargo, but something like a Wells Fargo. So you think a company has the ability to go get a line of credit, but you know something like that's going to take 60 to 90 days to fund, and you need quicker capital. So they came to us saying, look, we just need 100 grand, and we're okay with the cost of capital being higher. We need something that funds quickly. So we're able to secure them a term length of 26 weeks. So half a year, and a factor rate of 1.18, and they're making payments of $4,500, a little over $4,500 for the length of that term on a weekly basis. And then the second industry that we funded in was technology. So this is a technology services company, and this was someone who had a little bit higher risk profile. So time in business was good, revenues were great, but they had some elements of their personal credit history that made it a little bit tougher to secure traditional financing. And so, but again, because they had excellent business revenues, we're able to get them an approval of $300,000 at a factor rate of 1.22 over 52 weeks. And so they're making payments of $14,000. So this is the kind of customer that's going to have, you know, when you talk about traditional financing sources like your credit unions, and your local and regional banks, they're going to have a tough time with that personal credit history, but this product ended up being a great fit for their needs. All right, so the next product we're going to talk about is a line of credit. So I'm sure everybody on this call is familiar with a line of credit. I would say the best comparison when it comes to consumer lending is going to be simply a credit card. So a revolving facility that you can kind of tap into when you need the money and then pay it back, you know, on a monthly basis. So essentially when a customer is approved for a line of credit, they're granted access to this facility at closing, and then they make incremental requests for capital. So once again, it's revolving meaning that they can pay the balance down and it replenishes itself, which we'll kind of walk through an example in a second. They can pay interest only on the money that they're using, essentially. So they're not paying interest on the full approved amount. They're just paying on the money that they're actually using at the facility, and there's no prepayment penalties. So if the customer only needs, they're approved for this line of credit may be open for 2 years, but they only need it for 6 months and they ultimately want to close it out, there's going to be no penalty associated with that. So again, in this example, you may be approved for $100,000, but you only need 30K right away. You can simply take that 30K and what's known as a draw, which will be set on its own repayment schedule, which we'll kind of walk through an example in a second. And that the rest of the $70,000 will be sitting there to be used at a later date. Then if they go pay that 30K back off, the balance replenishes up to 100K. You can see why this is such a useful tool for working capital, especially if a business is, has seasonal tendencies or unpredictable expenses or any of these other factors that affect small business owners. All right, so when's this a good use case? Well, again, like I mentioned, working capital is always a good one. Recurring costs is also a good one. Short-term expenses, bridging cash flow, financing inventory, and finally, emergency fund. So one common phrase you hear in our industry a lot is go get the loan before you need it, right? This product is a great example of that. It's always good to have access to a capital facility before you find yourself in a bind, right? And so this is the product that is probably the best fit for something like this, right? You make sure you have access to this capital, and that when the time arises, you can go ahead and draw on these funds and use them as needed. So again, benefits, it's access to that reserve capital that we just talked about. The usage of it is flexible. So if you don't need all the money right away, you can kind of draw on it as an as-needed basis. And finally, this is a highly cost-effective product. So when you compare this to something like a short-term business loan, the cost of capital is going to be significantly lower, provided that it's used in the right way. So again, when we're trying to determine if this is a good fit for the customer, kind of the big three on the screen here are going to be what you're looking at. So how long have they been in business? What's their credit score, monthly revenues? Now, here are the required criteria in the line of credit space is they're going to have less options, in all honesty. So while we may be able to secure a line of credit for a business that's been around for a year, 600 FICO, 10,000 in monthly revenue, they're not going to have a ton of options. To really have the widest variety of options, you're going to be looking more at these preferred criteria, 25,000 in revenue per month, 650 FICO, 2 years in business. So just keep that in mind when you're submitting for someone who kind of falls in between these buckets. You know, there may be an opportunity, but the cost of capital is going to be a little bit higher, and they may not have quite as many options than if they were above these preferred criteria. So again, the three factors that we talked about on the last screen are going to be the key drivers in terms of terms and pricing on these deals. Industry will also come into play. And again, there's higher risk and lower risk industries. And finally, business credit score for larger requests may come into play as well. So there are bureaus, PayNet, by example, that essentially give a business a credit score in the same way that consumers have credit scores. And so that may be something we look at on a deal that's $200,000, $250,000, $300,000, but will not come into play for the smaller requests. And again, like we talked about on the short-term business loans, there's going to be elements of their bank statements that will impact the underwriting as well. So has their balance dipped below negative? Do they have a high number of deposits or a low number, right? These other factors will come into play during underwriting. And so what do terms look like? Well, the longest term line of credit we're generally going to see is 36 months. I would say, for B plus, A minus, AA plus customers, you can see 24 to 36 months. For the higher risk customers, you're going to see stuff coming in 12 to 24 month range. For the best customers, interest rates are going to be starting as low as 10%. Candidly, there's not a ton of businesses that are going to qualify for that low benchmark rate. But for even the B plus customers, you're going to see a rate somewhere in the 12, 13% range. And then you've got the customer generally responsible for making payments on a monthly basis, but if they're considered higher risk, they may be set on a weekly or bi-weekly schedule. All right, so now I want to walk through a brief example of how you would actually calculate payments for a line of credit like this. So like I briefly mentioned, the facility is set up and then the customer can take draws on an as-needed basis. The way our lines of credit work, and this is a little bit different than the credit card example, is when the customer makes that first draw, that draw is going to be set on a specific repayment schedule that is included in the approval. So if the customer is approved for $100,000 on a 24-month term at a 10% interest rate, when they go to take that first draw of, let's say, $20,000, that $20,000 request is going to be set on a 24-month repayment period. This is hugely advantageous to your customer because it's going to lower their monthly debt burden. So in the event that they really need to hold on to this money for some period of time, maybe several months, until they can actually pay it back in full, they're not going to be responsible for some balloon or anything like that. They're just going to be simply paying it down over a 24-month amortization schedule. So the way you would calculate that here in the example of the $20,000 draw is we use a 30-day billing period, 365-day year. Most people do the same. So you're simply, you've got two components, right? When they take that first draw, they've got what they're responsible in paying down on the principal over the 24 months, and then what they're responsible for paying interest on. So, in the first line here, you simply take the annual interest rate, multiply it by the draw times 30 days divided by 365, and you come up with what they're going to owe in monthly interest. And then you just simply divide the principal. So the $20,000 draw divided by the number of payments, you get that 833 number. You add them together, and this is what their total principal and interest payment is going to look like on that first draw. So now going on to the second slide, if they hold on to this money for 2 months and they decide there's other working capital needs that have come up, well, now they have the ability to go take a second draw. And the way you're going to calculate the principal and interest payments on the second draw is going to be the exact same. And now if their total, the amount they have total drawn is the 20 plus the 10, so they've got $30,000 outstanding, their monthly payments are now going to be based on that total draw amount of $30,000, which means they still have access, in this case, to $70,000. And in the event that they decide to go pay it off in full there's going to be no sort of penalty there. Or if they decide to go pay off the first draw of $20,000, now that line of credit's going to replenish back up to, in that case, $90,000, and they're only going to be responsible for those monthly payments based on the $10,000. So again, you can see why, if used properly, and if taking draws in conjunction with the timing of your business expenses, this is a very beneficial product to a lot of small businesses that require this flexibility when it comes to their financing. So another two examples on the screen of deals we funded recently. These would both be companies that kind of experienced some seasonality. And so both good examples of someone who wanted to have access to that capital before a strong need for it really arises. So the first business was in medical device sales, and because they had great revenues, had been in business for a while, and their sponsors had great personal credit, we're able to get them $75,000 at what is very close to our lowest rate of 10.25%, and they're making monthly payments using this money to hire short-term contractors for those kind of busy seasons. And the second company was a landscaping services company, so specifically commercial landscaping outside of large apartment buildings. And again, they do these big projects for these large apartment buildings, but they don't necessarily get paid right away. Maybe it takes them 2, 3, 4 weeks to get paid for these big jobs. And so they need the ability to have some capital to work with until they get paid on those outstanding invoices. So we're able to get them $53,000 to serve those needs at an interest rate of a little over 12%, and they're making 2 payments a month in this case. So again, great product for both of these businesses that they ultimately benefited from, and that additional capital allows them to grow and take on new clients and hire new people, et cetera. All right, so the next product we're going to cover today is what we call the bank term loan. So I'm sure many of you have heard of a term loan kind of in general, and of course banks supply these often. And so this is going to be more what you consider a conventional term loan product. So it's going to be based on, rather than a factor rate, it's going to be based on an APR. The customer is going to be responsible for monthly payments, and the term length is going to be somewhere between 6 and 84 months, with the payments fully amortizing based on that approval. So you get a 7-year approval with monthly payments based on a 10% APR. You're going to come up with that monthly payment based on, a fully amortizing 7-year loan. So a lot more traditional in that sense. So when is this a good fit for your customers? Well, again, I mean, working capital is always a good one, right? Depending on how your customer wants to be making payments, how they want to set up their balance sheet, all of these products are a good fit for working capital. But it's also a great fit for large one-time expenses. So, for example, if you have a large expenditure coming up and it's not something you're really going to reap the benefits of right away and be able to pay this loan down quickly, and you want it to be spaced out over a longer amortization period, this product's going to be a great fit. Purchasing inventories, another good one. Operational expenses, and debt refinancing is another really good one. So kind of going back to the short-term business loans for a second, like I mentioned, that's a higher risk product. And so a lot of times when you have a business coming in that's a little bit newer and is not necessarily qualified for the financing that they would want, we may be able to get them that approval for a shorter period of time. But if they use that capital wisely and then they grow as a business and they get some more time in business under their belt, that's where this bank term loan product is going to come into play. So now they've got a demonstrated history of repaying capital. They've got more time in business under their belt. And now maybe they have these outstanding short-term business loans that cost a little more than they would like. And now they're able to get qualified for something a little more cost-effective. So we can refinance them out of that debt with this bank term loan product. And that's probably one of the most common use cases for a product like this. So again, what are the, sorry, Greg, go back real quick. So what are the benefits of this product? Well, again, it's highly cost effective. So the cost of capital on this compared to a short-term business loan is going to be much lower. And then also it's going to be the longest available terms of any business loan product that we have. So taking real estate out of the mix, if you get an approval for up to 7 years, that's something that you're not going to see in the line of credit space or in the short-term business loan space. So again, one of the things you'll notice right away on the borrower criteria is the threshold is going to be much higher for this product. So full transparency, this is a much more difficult product to get approved for. So this is not a product we would consider useful for higher risk businesses. So we want to see a business that's been around and generating revenue for at least 2 years, personal credit scores over 650, and monthly revenues over $20,000. And that's the low water mark. So ideally, they have 3 years in business, 700 FICO scores, and monthly revenues in excess of $35,000. So as you can imagine, not a ton of, that's going to weed out a lot of small businesses that may not be a great fit for this. But for those that are a good fit, it's a highly cost-effective product. So terms, like I mentioned, are going to range all the way from 6 months to 84. I would say most of the approvals we see in this space go in the 3 to 6 year range, with the lower risk borrowers qualifying for that 5, 6, 7 years. Interest rates are going to be as low as 10%, which is, by the way, highly competitive with your traditional lending institutions, your credit unions, and your federal banks, et cetera. Right. So this is a product that is competitive with everyone in the market. And the customer's, again, responsible for monthly payments, which is great from a budgeting point of view. So how do we come up with payments? Well, I'm not going to put an amortization on the screen here. The way we do it here at Loanspark, we have amortization tables built in our system. If I'm working with a customer and helping them come up with their payment, I'm going to use just the payment calculator website. We don't have a specific one that we recommend. I mean, there's no affiliation, but there's one called paymentcalculator.net that's easy to use. But essentially, any generic loan calculator will let you take the inputs on the left and will spit out the payment on the right, unless you know. So in the case of a $100,000 approval and a 48-month amortization period at a 12% APR, you can come up with what the monthly payment's going to be for the customer. So in this case, $2,633. So again, a couple more examples of customers we've worked with in the past. One example was a restaurant, so in the food and beverage industry, and they're looking for capital to essentially, I believe this was for additional staffing. So they're looking to hire more employees and grow. And of course, as many of you on the call may know, during the period of COVID and coming out of COVID, staffing for restaurants has become a lot more expensive. And so this business essentially just needed more money to pay for their staff to keep up with the times changing. And so we're able to get them $120,000 at a rate just shy of 12% over a 5-year term. And the second was another landscaping company. So actually very similar to the line of credit example. So commercial landscaper, do more than just apartment buildings, but everything like that. And they were looking to purchase more equipment for their business. And while we do have equipment financing options, which I'll go into in a second, in this particular case, that program wasn't a good fit for them. So instead, we're able to give them a bank term loan for $300,000 at an interest rate, and it should say interest rate here, not factor rate, but an interest rate of 13% over a term of 48 months. All right, so like I just mentioned, we also offer equipment financing as well. And so I'd kind of like to delve into that product now. So I think the first thing that's important to cover on this product topic is going to be the difference between a lease and a loan. So a lease, with the definition here on the screen, is a contractual agreement between the owner and the lessee for a specific period of time in exchange for set payments. So what this essentially means is that if your customer is looking to buy a tractor, for example, the company financing this tractor or financing the lease is essentially going to be the one owning the tractor, and then your customer is going to be making lease payments to them. Whereas in the example of the loan, it's the customer that already owns the equipment, and they're making payments on the loan. Once the loan is paid off, then there's no more loan in place, and the customer. So at the end of the loan, nothing really changes because the customer already owns the equipment. At the end of a lease, the customer does not own the equipment, although they will have the ability to buy the equipment outright at the end of the lease. So the key difference between the two is the ownership. It's who actually holds the note on the or holds the ownership of the equipment. There's also some differences between the two as far as what kind of down payment is going to be required, and also the ability to finance soft costs. So in the equipment space, soft costs, the two most common are going to be delivery and installation. So of course, if you have somebody buying 10 tractors for their construction business or whatever business it is, right? Delivering something like that is not going to be free. Same thing with installing very expensive restaurant equipment, also not free. So the ability to finance those costs into the package is kind of going to vary based on whether it's a lease or a loan. So when is this a good fit? Well, of course, in general, I see there's a question on these EFAs. Yeah, thanks for the question, Dane. I will cover that. So when is this a good fit? There's tons of industries that we can finance equipment in. I think, while you can use something like a bank term loan for equipment financing, this product is just generally going to be a better fit because that's what it exists for. And so, in the case of a lease, the customer may be able to get better terms when it's a lease versus a loan. And then also, we could typically finance the equipment loans a little bit faster than the bank term loan. So anyway, there are cases where equipment financing kind of achieve the same goals as the bank term loan, but the terms of the loan just end up being a better fit by going with this program. So on the screen here, you see tons of different types of equipment that we finance. So we work in the trucking space, can finance trailers, medical equipment, computers. Technology is eligible as well, which some people don't realize. Construction equipment, landscaping machinery, industrial machinery, agricultural machinery, commercial printers, renewable energy equipment. This is only a fraction of the list of what we can kind of offer. I would say this is what we see more commonly, but restaurant equipment isn't on this list, which is certainly something we can help with. I mean, there's a wide variety of equipment types that we can help you with. So if you're ever unsure if a piece of equipment that your customer is looking to buy is a good fit for us, you can always reach out to your contact at the company and we can kind of give you a good idea of what that will look like. So again, some of the benefits of this product, well, cash flow preservation is a huge one. Of course, if you have most businesses don't want to shell out cash for a very expensive piece of equipment. So this will allow you to set up a financing facility and then simply make these monthly payments while kind of keeping cash in reserves and using those for other business purposes. Convenience and speed, these can typically fund in 7 to 14 days if we're moving quick, sometimes even faster. It's not common to get 100% financing, so no down payment, but it is possible. Terms can be flexible. So if you want to set something up on a shorter or a longer amortization schedule, we can kind of work with you there. There's, of course, tax advantages when it comes to borrowing money, kind of similar to the real estate space. So think Section 179 depreciation or writing off the interest of the loan in the case of a loan, not a lease, et cetera. And then, of course, innovation and upkeep. So a lot of businesses are simply required to have newer equipment in whatever their line of business is, or perhaps if they don't have the latest and greatest equipment, they will fall behind their competitors. And so ensuring that you can kind of rotate out that equipment that you're using for your business and having the financing capabilities to do so is going to be very important when it comes to staying competitive in whatever industry your customer is in. So kind of similar to the short-term business loan, the criteria range here is very wide. So we can do anything from kind of your highest risk borrowers to your A+ businesses, really everything in between. So the bottom of the bottom threshold criteria that we want to see here is going to be someone who's been in business for at least 6 months with credit scores over 575 and monthly revenues in excess of $10,000. That customer will have certainly some financing options in the equipment space. But again, for a customer that's been around at least 2 years and generating revenue, monthly revenues over $15,000 and FICO over 660, they're going to have the widest variety of options and more competitive terms. So again, wide range here, but expect the terms that you see to kind of be in line with the risk profile of the borrower. So we have two different categories of programs in the equipment financing space. I mean, it can be more granular, but we'll kind of keep it high level and say that there's two in general. So the first is what we call app only, which is exactly what the name suggests. So we're not collecting the business tax returns. We're not looking at their bank statements. We're simply looking at a credit application, looking at the consumer's credit report and their equipment invoice. And we can secure an approval just based on those factors alone, which is, as you can imagine, highly advantageous. There may be businesses that don't manage their expenses well, and their business is losing money on paper, even if it's not in actuality. Perhaps they don't have the time to go get their tax returns from their accountant, or they don't want to show their bank statements. There's a ton of reasons why this program would be a great fit. And this program is generally going to fund pretty quickly. And so, a really great option. Now, don't expect to fund deals $600,000, $700,000, $1 million app only. But in some cases, this program may go up to $500,000, depending on what the equipment is. So very, very advantageous to a lot of small businesses to have access to this. And so, like I mentioned, up to 500. Yeah. Great. It's all the stuff I've covered already, but yeah. All right, so full documentation program is going to be, again, just what it sounds like. So, in addition to their application, their credit report, and their invoice, we're going to be looking at how the business is actually doing. So looking at their bank statements, looking at their debt schedule, what outstanding debts do they have, looking at their business tax returns or internal financials, their profit and loss, their balance sheet, etc. So, of course, you think, well, if there's a higher level of scrutiny and the business is passing these underwriting tests, so to speak, you're going to think in general this program is going to have more competitive terms, and that would be the case here. So higher level of scrutiny, but they can also get approved for a higher loan amount at typically more competitive terms. That's kind of what you would come to expect from a full documentation program. And again, higher loan amounts, less money down, and better cost of capital in general. All right, so how do we come up with pricing and terms? So I'm sure you're noticing a lot of themes on these slides, but again, time and how long a customer has been operating in business, what kind of revenue they're generating, and their credit score are going to be kind of key drivers. Industry as well. And then one other factor that comes into play in the equipment space in particular is the equipment itself. So namely the age and the condition. We generally don't like to finance equipment that's more than 10 years old. Like I mentioned before, that may be where something like a bank term loan is a good fit because the equipment itself is not eligible for this program, but the financing structure of that product makes sense for the customer. But these 5 factors are going to be kind of the key drivers in how we are determining the approval. Now, of course, for the app only, we're not looking at their bank statement, so we may not know their revenue. But per their application, we will ask what their revenue is. And of course, we'll do a soft pull on their credit report, or in some cases, a hard pull, and be verifying their time to business. So again, these all paint a picture of the risk profile of the customer, and pricing and terms will be derived from that accordingly. So term length for these leases and loans are going to start somewhere around 24 months and range up to the 7-year mark. I would say 4 to 5 years is the most common range for the approvals. Rates may start as low as the mid-8s, but again, since we can finance this product for higher risk customers, that number may be much higher. It could be 16, 18, 20%, depending on the risk profile of the borrower. So like I mentioned, 100% financing is available. I would say it's fairly uncommon. We're going to see most offers coming in requiring at least 10% down. And in some cases, there may be a security deposit required as well in the case of a lease. Like I mentioned, we can finance soft costs as well, so delivery and installation, depending on the deal. And I think someone actually asked a question about a dollar buyout. So our leases have dollar buyouts available as well. So what that essentially means is in the case of a lease, let's say they borrowed $100,000 and it's over 5 years. And at the end of the 5 years, they've made all of their they've paid that principal down from 100,000 to zero, and paid all the interest that the lender required as well. And there's essentially a zero balance. They can essentially pay $1 at the end of that term to own the equipment outright. So that's why it's called a dollar buyout. They're buying the equipment for $1, which you can see kind of makes sense from both sides' point of view, right? The lender has already recouped everything that they expected, so the principal and the interest. And the customer is saying, well, I've essentially paid this loan off in full, even though it wasn't a loan, so I should be the one who owns the equipment now. And so, one might wonder why you wouldn't set it up as a loan in the first place, but if you're the equipment lender, it's generally less risky if you're holding ownership of the vehicle until the end of the term. But then something like a dollar buyout is going to really bridge that gap and make the customer feel like, okay, the lease really allowed me to manage these payments and have lower payments on a monthly basis, but I still get to own the equipment when all is said and done. So a great advantage there. All right, so a couple examples on the screen. The first, again, trucking is a big industry for us when it comes to financing equipment through leases and loans. We see a lot of companies looking to buy trucks, add new trucks to their fleet, etc. So we had a company come to us that already had a truck of, I believe, 12, or a fleet of at least 12 trucks, and they're looking to buy another one, add a new driver to the company. And so they're looking to buy this thing for $50,000. They're willing to come with a 20% down payment to kind of secure a better cost of capital. So we're able to get them approved for a 4-year lease at 9.625% with a dollar buyout at the end. So after they've made payments on this for 48 months, they'll own this truck outright at the end if they elect to do so, which they most certainly will. And the second example was a customer in the hospitality industry. So I believe this was a hotel looking to replace their commercial laundry machines. So the machines were quite outdated, and so they needed to kind of do an overhaul as part of the hotel renovation. So they came to us looking to buy 5 of these Unity systems, which were a little under $5,000 a piece. They're able to bring, in this case, 25% down to secure a better cost of capital. Now the rate came in a little bit higher than in the first example because of the customer's credit score. So they'd had some troubles in the past, but we're still able to get them what's considered a pretty decent approval over a 5-year term with an interest rate just shy of 13%. All right, so the final product category we're going to talk about today is SBA loans. So we've got 7A and the Rapid's what I'll cover first. So SBA loans, and Rapid specifically, are government-backed loans with low rates, fixed monthly payments, and generous loan amounts, and a more streamlined underwriting. So this Rapid 7A program is essentially an offshoot of the regular 7A program that just has a less intensive underwriting process. Cost is a little bit higher, and the loans size maxes out $150K. But if any of you have experience with 7A loans, you'll know it's quite time-consuming to get approvals and get deals funded, maybe in the 60 to 90-day range. So this Rapid program allows us to kind of shortcut that. So minimal documentation, faster pre-approvals, faster funding, and, which is hugely important, no debt service requirements. So when is it a good fit? Well, you've got your working capital, your debt refinancing, very similar use cases to the bank term loans. So inventory financing, operational, et cetera, and it's highly cost effective and has the longest available terms of, well, similar to the longest available terms of products that we offer. So criteria, like similar to the bank term loan, a little bit higher. You're going to want to see at least 2 years in business, preferring 4 years in business, at least 700 FICO, ideally 750, and at least $175,000 a year in revenue. But ideally, you want to see something, a business that's generating at least $500,000 in revenues. So in this case, the typical term slide should actually say standard terms because it's going to be the same every time. So for a business that's going to qualify for this loan, their loan amount is going to be set to 30% of their top line revenue from their latest tax return. So this program ranges from 50K to 150K. The term length is going to be 10 years, fully amortizing, so 120 months every single time. And the rate's going to be based on Wall Street Journal Prime plus 475, which today would be, I believe, 1225, if I'm not mistaken. The rate's going to be the same every time. It's going to be indexed on Prime, and they're going to be making monthly payments. So pretty standard approval that you would expect to see, provided the customer gets approved. So for customers that are looking for a little bit more money than the Rapid program can offer and are willing to go through a more intensive underwriting process, this is where a 7A term loan is going to come into play. So again, it's a government-backed loan. It's going to have very low rates, fixed monthly payments, and quite generous loan amounts. This slide actually, so larger loan amounts, faster pre-approval. This slide should not say no debt service requirements. There are debt service requirements for this product, which we'll kind of get into in a second. But again, for a customer that's looking for a lot more money, really $1 million to $5 million is where we like to fund these. This is the program that's going to be a good fit for getting that amount of money on a term loan. So again, very similar use cases to the Rapid and the bank term loans. So large one-time expenses, refinancing out of debt, using the money for working capital, financing the purchase of inventory, excessive operational expenses, and many, many more. And it's the benefits being it's highly cost effective and very long terms. So borrower criteria, I would say, of all the categories we discussed today, is the least important on the 7A term loan. So The time in business is a very hard line in the sand, so they need to be in business for at least 2 years. And their credit score is important, 640 and up. Revenues are important, but these approvals are going to be based more on debt service than they are on the actual monthly revenues. So the SBA generally looks at global debt service when it comes to underwriting these deals. What a global means is essentially when you're looking at a borrower. So if I'm looking at Cray and I'm underwriting Cray, I'm looking at Cray and how much money he makes at his day job and how much personal debt he has. Does he have a car payment? Does he have a mortgage, et cetera? But then I'm looking at every business he owns as well. So what kind of revenue and net income are the businesses that he owns generating, and what kind of business debt that he has. And that's essentially what global means. So it's painting the entire picture of all of the debt and all of the income this individual is affiliated with, and basically saying, if we give them more debt and we put a higher monthly debt burden on them, can they handle it? And that's essentially what the SBA is going to be looking at. So while these numbers on the screen are a good proxy to figure out if your customer's a good fit, ultimately the underwriting process is going to be a lot more lengthy than just running it through a risk algorithm the way we do for some of the other products. So like I mentioned, while the 7A program will allow for lower loan amounts, we typically like to work on deals that are $1 million and up. The reason is that the underwriting process for this product is very intensive. So we're looking at 60 to 90 days or even more to close deals like this. Now, I mean, well, of course, we can do it in 60 if the borrower has their ducks in a row, so to speak, all their finances organized, their accountants provided everything on time, et cetera. But these are not easy loans to secure approvals for. Like I mentioned, you've got the whole global debt service underwriting process. There's going to be a deep background check. We don't want to see anybody who has historical bankruptcies, judgments, felony convictions, et cetera, right? So it's a fairly, of all the products that we offer, this is going to be the most intensive underwriting process, and which is why we like to see those higher loan amounts to really make it worth it for everyone involved. We want to make sure, you as the broker referral partner, in this case, get paid, and also that the customer really gets an amount of money that is worth the time that they spent working on a deal like this. Well, the term is always going to be based on 10 years fully amortizing, and then the rate is generally going to be around prime plus 3% and maybe a little bit lower or higher, so it varies a little bit, but they're always going to have monthly payments based on a rate somewhere in that range and a 10-year term. So as you can imagine, I mean, if prime plus 3 is today is in the low 10% range, compared to some other products, that's going to be very competitive cost of capital, especially when you consider the fact that they can get approved for up to $5 million.
Awesome.
So you'll notice, okay, I'll knock this last slide out. So you'll notice we didn't really cover any examples on the SBA side. And the reason is that we wanted to kind of give you a better idea of industries that these products serve. So because the SBA is a government-backed loan program, they're very particular about what industries they will and will not work with. So I'm not going to read everything off on the screen, but on the left is a list of kind of eligible businesses that are a good fit. On the right is prohibited businesses. If you're ever curious about whether your customer's business is a fit for the SBA or not, for an SBA program, you can ask anyone on our team, but you can actually just Google it as well, because the SBA itself has a website that lists all of its industries and what's eligible and what's not. So with that, I will hand it back to Craig.
Awesome. Thank you, Thomas. And for any current partners on the call or prospective partners, there's also an industry tier guide available in the partner portal that you can access at any time. Before we move into Q&A, I just want to go over a couple of slides here to go over how to work with Loanspark, how to market, that sort of thing. So for the broker partners on this call, many of you will benefit from leveraging existing client relationships, right? Maybe you did a deal with someone in the past, service their needs, and now you're able to offer these additional financing options. So reconnecting with those borrowers is going to be beneficial to you. You can also do email marketing campaigns, maybe a drip campaign targeting either your new offerings or a specific type of offering based on your client base. And you can also do social media marketing as well if you're active on LinkedIn, have some sort of following or something like that. For the referral partners, we recommend integrating Loanspark's platform with your platform. So that may be in the case of if you're a bright or brilliant partner, having some sort of landing page integration. Even if you're a Spark partner, just announcing on your website the types of products in business lending that you can offer to your customers. Sometimes information is all you need to draw interest from your clients. And then, of course, co-branding content. So maybe reposting LinkedIn's posts. We're very active on social media. We do a ton of educational webinars. Linking your customers to those types of content will be helpful. And then, of course, client support training. So if you have a team of LOs and you're looking to, or maybe business development officers or marketing employees, that sort of thing, we're happy to train your team, reiterate the types of lending programs we offer, and strategize effectively there as well. You can find all of this information and more by going to the partner portal. We've actually got under your Spark documents or whatever tier you are, there's a great guideline for both broker partners and referral partners to follow to help generate new leads. And of course, want to end off on a high note here, which is why would you work with Loanspark as opposed to anyone else? Well, we have the most flexible programs. I mentioned we have 300 plus programs spanning from business lending to real estate. We can really be a one-stop shop for you. Our closing times are extremely fast. We've gone into some of the products today that I've personally closed in less than 48 hours. So its speed of funds is paramount for apparently 85% of business owners. When they go to seek a lender, that's top of mind for them. So our fast closing times will help you get more business done. No depository relationship required. We're not the local bank that requires your customers to completely transition their banking information over to us. And that's a huge benefit for customers that are maybe servicing invoices, purchase orders, that sort of thing. You have the ability to pick between many of our offers with one single application. We close a ton of deals with partners who combine a term loan and a line of credit, or a rapid SBA loan and a line of credit, or an equipment loan and a short-term business loan, right? So the ability to pick between and combine multiple offers for tailored solutions to your customers is huge. Also, your customers will stay your customers, your clients stay your clients, your applicants stay your applicants. This is important. We work with many brokers, and they don't want their customer coming to us directly for the next deal. In the case that happens, it's still associated with you. You still get paid on renewals, whether you're a referral partner or a broker partner. Your clients stay your clients. It's a huge advantage. And you can broker and refer deals with us. As I mentioned earlier, and if you have any questions about this, reach out to myself or your dedicated account manager. You can pick on a file-by-file basis whether you want to submit a lead to broker it, or whether you just want to hand it off to Loanspark for us to work it directly. If you have questions about the differences, reach out to anyone on our team. And then, as I mentioned, probably at the very beginning of the call, there's no need for licensing. Anything outside of North Dakota, South Dakota, and Vermont, you're tapping into Loanspark's licensing, so you don't have to worry about studying for an exam to service one of your clients that comes to you with a request. And then finally, transparent reporting. If you are a current Loanspark partner or you're looking to become one, you'll notice that in the partner portal, you can track in real time your leads, your deals, and your revenue reports. So you never have to sit there on the sidelines wondering when something's going to be paid out or the status of anything you've submitted to us.